Right, so let's look at the US earnings season. So my screen this morning tells me we're about 86% of the way through reporting of the S&P 500. It certainly seems to be the case that the banking earnings have disappointed. Certainly, the market environment in the fourth quarter and flat yield curves made it relatively difficult for banks, for instance, to make good money, and also the basic materials sector is disappointed, although that's from a very, very big bounce back, so the number was quite big. But overall, you'd have to say that most other sectors exceeded expectations, or so we think. If you look at the S&P 500 overall, apparently at this stage we're about a 3.25% beat on market expectations, so nothing to worry about, you might say. Well, I think, as ever, the picture's a little bit more complicated than that. So let me throw in a few things for you to make you have a bit more of a think about all of this. So first of all, there's usually an element of bait and switch before earnings seasons. And what often happens is analysts trim their forecasts into the print and then declare that it's an earnings beat. And actually, if you look at the earnings estimates for the full year 2019 and 2020, you're already seeing an element of that. They're down by about 1.5% to 2% in both cases thus far this year. So that will tend to upwardly bias the momentum that you see in the market. The other thing to also take into account in all these results is that the so-called EPS, the earnings per share number, is really an EBBS number, an earnings before bad stuff number. Analysts like to adjust the numbers. They look at one-offs, particularly if they're one-off charges, and they tend to strip those out. Well, sometimes that's totally justifiable, sometimes it isn't. It's quite interesting to see that a lot of these one-off charges actually turn to be recurrent charges. So again, don't necessarily take these numbers at total face value. I'm not saying they're bad numbers. I'm just saying that, don't rely entirely on the headlines. Just be aware of the other moving parts that are involved. The other issue perhaps to consider, and this is from a top-down, a macroeconomic perspective, is that earnings in the US over the last year or so have certainly been massively supported by corporate tax cuts introduced by the Trump administration. What has also buoyed earnings numbers in the US has actually been an increase in operating margin. So this is after things like wages, but it's before things like interest rates, which we know are going to be going up this year for most companies, and also tax rates, which we know went down. So this strips a lot of that other stuff out. Those margins have been going up and are now at the levels that we saw in 2014 at an operating level. And that actually was a peak, strangely enough. It was a peak operating margin for US companies, and it was actually a reduction in that operating margin going to 2015-16, which caused this mini earnings recession that we saw in the market. Now, why is this significant? Well, it depends which way it breaks, because wage inflation in the US has been one of the areas where inflation has been relatively high. Most other measures have been very, very well behaved, and that in turn is why the Fed has been quite relaxed on raising rates this year. On the other hand, if wage pressures continue to build and that isn't offset by profitability, that ultimately is likely to weigh in either in pushing broader inflation measures up or in reducing company margins. So either you see smaller margins and all other things being equal, smaller earnings, or you see higher inflation across the economy, in which case the Fed is likely to act. So both of those, in principle, are headwinds for equity. So all I'm pointing out here is when you see that flash estimate of the earnings per share against analyst estimates, do consider there are a lot of moving parts in the background, both at the macroeconomic and microeconomic level, and only if you look at the whole picture are you likely to make the right call over the longer term.